Yes, welcome to ETCFO Leadership Summit. I'm going to discuss CFO with a golden balance sheet. And ladies and gentlemen, I have two strong people from the CFO fraternity with me. Jaimin Bhatt, the CFO of Kotak Mahindra Bank, and V. Ramakrishnan, CFO TCS. Gentlemen, welcome to this discussion.
Thank you.
Right.
Thanks, Amol.
So glad to have both of you here, and I'm sure I'm going to get a different perspective from both of you. One from the IT industry, and second from the banking sector. And considering the current challenges specifically of the pandemic, now obviously we are on the threshold, and the vaccination drive has also started. And maybe the world is not looking that unpredictable, which was there 6 months back. There is at least some predictability, some certainty there. But if we still look at the unpredictability and uncertainty, I will go ahead with my theme of breaking the chakra view. And Jamin sir, I will come to you and ask you a basic question. How CFOs can break the chakra view of the uncertainty, of the unpredictability? What do you think the weapon they should carry to break this uncertainty?
I think if you go back to when the whole thing started, possibly sometime in March, April, things were very, very uncertain. And so, as a CFO, you would have planned for a lot of things to grapple with that uncertainty, strengthening your balance sheet, making sure your capital was right. In all likelihood, slowing down growth. All of us went through that process of actually slowing down the growth of the balance sheet for a period of time. As we now get into a situation where things are becoming more clearer, honestly, it has not been as bad as what we started out with. Uh, if you drop the worst case scenarios in April, things would have been really, really gloomy. Possibly it has lasted a little longer than what people anticipated in April, but with things now coming out of the woods, you're now planning for how to get back and how to get back on your balance sheet, how to get back on activities which had slowed down, and how you get the growth engine back to normal. And there's enough signs, signals around the marketplace to say that this is time to get back. As a CFO, identify what are the areas which you will now getting comfort to grow. What are the areas where you still want caution? I do not think one can say let's grow across the board, press the accelerator as if you're back to sometime this time last year. I do not think we are back to sometime this time last year. It is still there are pockets where you'll need to be cautious. So identifying that and then giving signals about the fact that, look, these are the things which we could get along and step up the accelerator. So that's been exactly the thing. And at the same time, watch out for other signals. While the vaccination is a big relief, I think 2021 is going to be the big area of how this vaccination develops and how things get back. But at the same time, keep watching around for a possible risk of would there be a second wave? What is the impact of that? Thankfully, in India, we've not had the impact of that at all. And we hope it stays that way. But if it gets into that scenario, how do you plan for that?
Noted, Jamin sir. In fact, valuable thoughts and a good opening. Ramakrishnan sir, I will come to you and I will come with the same question. How do you think the CFOs can break the chakra view of the uncertainty?
So I think uncertainty is part of business cycles. So you can't really break the chakra view, but how can you manage that, right? And the uncertainty throws up both, as Mr. Bhatt said, it can throw up some opportunities as well as also create a lot of disruption. Through both these cycles, one of the key factors which will help, at least from a CFO and CFO organization and the larger organization, is how do you know your numbers? Yeah, you have to have systems and processes built so that you're able to harness the data within the organization, run analytics, have a very, very what you call a real-time view of what things are, how they are moving, and also what are those lag and lead indicators in your business. Some of them may show way to opportunity, some of them may show impending disruptions which are likely. So I think, and that can help tide over the situation. So investments in that, it could be investments in technology, it could be in investments in how you build your processes and systems, or it could be even behavior changes. But all of that coming together, I think, is a very critical input. And I think CFOs play a very important role in that. And and that is applicable across the organization. And that's, I think, very important.
Okay, noted, Ramakrishnan sir. In fact, good thoughts from you as well at the opening question. I have one more common question for both of you, and then I will get into the specifics. And this specific question is specifically about our panel discussion, which is CFO with a golden balance sheet. So, Jaimin sir, I will come back to you, and if you could guide us on how can CFOs make a golden balance sheet to survive a crisis like COVID-19.
Look, it's an all evolving thing. I do not think you can say this is it and this is the best we could do. It is always an evolving to see what is happening in the marketplace and how do you cater to what is there. So if you go back to the scenario when it started out, I guess most of us wanted to first look at our own stuff and say that are we fortified enough? I mean, when we started looking at our borrowers, what are the borrowers who were giving me comfort and what are the borrowers who were not giving me enough comfort? Clearly, one of the biggest things we saw was anybody who was highly leveraged as a borrower was something I would be worried about, whereas somebody who had the cushion of capital is something we were saying, look, he can survive longer. So keeping that in mind, one of the first things we also did, because we are at the end of the day, banks are the most leveraged institutions. You would have leverage of about 8, 9 times. So one of the first things we did was to see how much can we raise capital to cushion ourselves. We were possibly among the first companies around in that period to go out and raise capital. We had enough capital, but the whole idea was in an uncertain times, you want to keep your powder, whereby if the worst happens, you don't want to run out at that point of time. So that was the first thing to make sure that you did and fortified yourself. Thereafter, what was going around, you had scenarios where the government and the regulators gave moratoriums. So my borrowers had relief, they had time to pay me back. I did not have the same thing. So if a depositor came to me knocking around, I had to make sure that I paid the depositor in time, though my borrower was not necessarily paying me in time and he had the relief. So again, how do you monitor and how do you make sure that you have an asset liability mismatch which is curtailed so that you have enough liquidity to meet your depositors thing? So making sure that your depositors and your assets and liabilities were enough matched was the other big thing. Of course, in these times, you also fortified yourself by taking a hard look at cost, taking a look at how technology can benefit you, bringing in efficiencies, and some of those efficiencies are not necessarily what you would keep for the period of the pandemic, but even going forward, and how you can re-engineer the whole process, which would help you going forward. So, I think to an extent, this gave us an opportunity to relook at it, and ultimately, it is your balance sheet which counts. And to that extent, in the banking world, it is easier to say, let's continue to grow. But if your belief is I can lend today, the borrower has to pay me back after a point of time. And if he doesn't pay me, the pains will start showing up 6 months, 1 year, 2 years later. So if you're not comfortable of that, slow down the growth, which is what we ended up doing in terms of the fact that for about 6 months, you ended up having negative growth on the balance sheet and you were trying to conserve capital at that point of time. So it's a mix and match. You keep watching. The caution which was there way back in April is no longer the same today. And today you'd be more bold in terms of taking certain steps, and you keep evaluating that and see how you can restructure the whole thing month on month, quarter on quarter in terms of how your approach will take forward.
I think very, very important. And yes, we have seen major challenges in the banking sector and specifically with the PSU banks, when it comes to NPAs or defaults. And, then banks started raising lots of funds and, there were risk covers initially. I think major challenges and it's a, difficult task for the bankers. Thank you. In fact, those meaningful thoughts, Jaimin sir and Ramakrishnan sir, I would like you to also tell us the same thing, how can CFOs, make a golden balance sheet to survive a crisis like COVID-19?
Over the years, it's been very clearly established that to manage a downturn, a strong balance sheet has helped people, has helped companies. Having said that, I think some of the things which Mr. Bhatt talked about are very relevant in other commercial organizations besides banks. I think in the immediate aftermath of the lockdowns, etc., I think the immediate focus was on liquidity, right? Companies were trying to ensure that they have enough funds to meet the contingent situations. Now, the tech sector as well as in the services business, we are from a cash flow perspective and cash generation business, we are fairly strong.
Right.
So while the liquidity per se it was not posing a challenge immediately for this our businesses, we had to also look out for our customer profiles because customers in different sectors were impacted very differently. There are sectors like airlines, retail, non-essential retail, hospitality industries, which were severely affected in the immediate aftermath. And there are other sectors which actually were growing even more faster, right? So you have to you have to keep ensuring that the liquidity from some of those customers is not affected because it will ultimately have an effect on your cash inflows, etc. The tech sector is not very geared, so I think gearing is not an issue, with exceptions. It's not a question of, but you'll have to. It's not just to meet the situations of a downturn. We will also have two things. One, opportunities which come up where you will need immediate investments, immediate infusion of funds, as well as in the immediate aftermath, you have to take care of the safety, security, and also the investments in terms of making your work environment very secure, right? Because you're dealing with data, you're dealing with issues around the data privacy, etc. So you have to have a very safe and secure environment in which people can operate. So that will require certain tactical investments, etc. So one is the opportunities for investing in those immediately where you might not have thought about it earlier, but you'll have to take those decisions quickly. The second is if there are opportunities which require some infusion of funds, you should be able to make those investments and leverage those opportunities immediately. So from a balance sheet, so the stronger your balance sheet, you're able to do these things more effectively.
Again, valid thoughts, Ramakrishnan sir. I'm sure the participants or the financial professionals that are watching us, will actually take a good note of both of you and the meaningful thoughts that both of you are sharing here. Jaimin sir, I will come to you on specifically about the banking issues. Obviously, uncertainty is still there, and there is a fear of slippages. So, under these circumstances, how are you actually identifying the growth areas for you? That is part number one. And part number two, if you could tell me more about, are you going to be cautious in 2021? Or how cautious will you be in 2021?
If you go back to, that's where your data and what is the data showing up comes in. And if you've started looking at data going in the recent times, and maybe the last 2-3 months, you're getting comfort in certain areas. And to that extent, it is fine to grow in those areas. And at the same time, your data is showing you signals that you have to be cautious in certain other areas. So clearly, you use that to determine how is it, which are the areas which you will start doing. And if you go back to our specific example, we stepped up our activity on home loans sometime in October, November. And we just said that, this is a space which we like. We wanted to make sure that we would step that up. And we've gone a little aggressive on that. If you look at the numbers which we just declared a couple of days ago, we have shown growth in that in this period. Again, the whole of the area which we talked about, which was showing that delinquencies have actually come down or are getting comfortable, whether it is the larger corporates, whether it is the whole agri-related area, not tractors, another thing because we really saw that the effect of the pandemic on the non-urban India was lesser than what was happening on the urban India. So you again look at that and you're okay to step those up. On the other hand, and this is something which we had taken a call way back, even slightly before the pandemic, that what was showing trouble are the unsecured retail. And that is to an extent understandable. I mean, let's face it, while as both of us mentioned, this was also the time when people started looking at efficiencies, their costs and all that. Now, a lot of larger corporates, if you look at this period, they've actually got their bottom line protected to some extent by cutting cost. While the revenues have slowed down, costs have also slowed down, and to that extent, profitability has not taken the impact of what the revenue slowdown has been. So while at the entity level, it is fine, at some stage, what I have saved in cost has affected somebody else's revenue. And that somebody else, in a lot of cases, ends up being the smaller enterprises and some of them either end up not paying their employees, or some people have lost jobs. So the whole unsecured piece, where you depend on the whole credit card things, or your unsecured personal loans, or even things like consumer durables and all of that, you do see that those are things which you need to be watching out for a couple of reasons. Where if those things, if those borrowers don't get enough liquidity, the first thing that they would protect is to make sure that they don't default on a home loan. Then they would protect the fact that they don't default on a car loan. But a credit card, they would not mind, deferring it or not paying at all. So again, you identify pockets of areas which you may want to be comfortable with, and pockets where you stop, you kind of draw caution to the not right now. We're not saying we shouldn't grow, but not right now. Was also recognize that if there is a large corporate who, or even a medium-sized corporate who's not paid, my cost of collections is reasonably lesser. Whereas a guy who's not paid me a 25, 30,000 credit card, the cost of collections for that is proportionately much higher. So you just have to be balancing all of that and identifying pockets which are growing and which are not growing. But overall, to come back to your last part, if you look at 2021, as I said earlier, the outlook which people now have, especially in the last few months, is significantly better than what it was 6, 8 months ago.
Mhm.
While we may not have got back overall to the same activity levels as what we were, say, in last January, but the comfort levels are such that the whole break which people had put on growth for about 4, 5 month period is now certainly getting relaxed. And you are now seeing much better growth coming in. So for 2021, compared to what the outlook was 3, 4 months ago, your outlook is certainly far more positive. In fact, you've seen agencies like IMF and all
Yeah.
talking about a much better recovery for FY22. And if that's something which we believe, typically the banking credit growth has ended up being better than overall the GDP growth what the country shows. So there is a lot more optimism as we speak today than what it was for the whole of last year.
Allow me to get some more from you,
Sure.
specifically on the corporate and the rural side. When you specifically spoke about the rural India, uh, are you going to focus more on the rural India, and specifically the retail segment than the corporate segment? Because still, there are a lot of issues.
No, if you look at rural India as non-urban place, and I say non-urban, I'm slightly distinguishing between rural and non-urban. The non-urban space has been lesser impacted than what has happened in the urban India.
Mhm.
You had people who left. I mean, especially when you start looking at the unsecured pieces, the small ticket pieces lending in the urban India. So when you talk about credit card or personal loans and whatnot, the impact of what is there in urban India is nowhere near the same if you look at rural India. And in any case, if you look at most of the balance sheets, you've seen comfort coming in that area. Whether it is, as I said, we happen to be among the largest lenders on tractors, and
Mhm.
possibly among the banks, the largest lender in tractor.
Right.
And we've seen how people have kind of taken those loans, paid back, whether it's on crop loans or a host of other areas, construction equipment, for example. You started, people take those for building roads. That activity levels have gone back to what it was earlier. So host of areas in those segments which people have got comfort, and it had not slowed down to the levels what we saw here. At the larger end corporates, if you saw even the whole period of moratorium 1, moratorium 2, the restructuring, look at the number of people or the number of large corporates who have even opted for it. It is
Mhm.
very, very small. So the larger end corporates have actually been able to manage this well. To an extent, also helped by the fact that a number of them, just as we spoke earlier, have actually fortified themselves with raising more equity. And if there's a borrower who has raised more equity and has cushioned himself, as a lender, I'm more comfortable because that equity is going to stand behind me when it comes to if there's a problem. So with that kind of comfort which is built in for the lender, the larger end corporates have actually got more comfortable than what we were earlier. So it is quite a revealing thing that you've seen the larger end corporates getting more comfortable. You've seen pockets of areas where you've seen comfort growing in, and you will see that play out over a period of time in other segments. And if you look at MSME, um, uh, some of them were impacted, but you had the Government of India scheme, which helped them get cash and made them survive this whole period, and that certainly given them a big breath of life.
Okay, I think important thoughts, Jamin sir. Ramakrishnan sir, the specific question is about TCS. The results of the TCS or the balance sheet of TCS is always a case study for many other companies because you have been giving hefty returns to the shareholders. In the current situation, what is driving the growth for the TCS? How strong is your deal pipeline, and more importantly, is it because your protective approach towards the balance sheet, or generally there is a lot of spend, the companies wants to have in the IT space right now?
There is partly an macroeconomic factor, but partly also certain things which we have done over the years. The macro factor is that technology is making a huge inroads into every walk of life, every business, including public services, government, the way it is reshaping how we transact, how we deal with many things, and all of us are seeing it in our own personal lives and also in professional lives. So that is definitely it's a multi-year sort of this is likely to definitely continue because and technology is helping in both ways for companies to become more efficient, to drive to have optimize their cost structures, etc., but also in sort of reimagining their whole business model, their products, their services, how they understand their customers better, their potential customers better, how they reshape their supply chain. So when that sort of impact is there, obviously you see these opportunities. But then opportunities would be there. How do you successfully harness them? I think 3 or 4 things. You have to have a deep understanding of the particular industry, whether it's a banking. You need to understand the nuances of banking to a very significant degree, or any other sector, whether it is retail or manufacturing or insurance. And second is you also have to have a wide array of technologies because the technology landscape is also constantly changing and evolving. What is relevant today will become irrelevant a few years down the line or even earlier. So we need to have a very good understanding of the various technologies and what they can bring into the context. The third is the deep knowledge of that particular customer environment where we need to understand, and that you can call it a contextual knowledge. We need to bring all these together, and we also in a position to provide these services on a very global scale and in a very highly distributed model. So bring it all together and then tap these opportunities which are happening. So this is this one. I think your other question was on whether the balance sheet, how does it play? Of course, the strength of your balance sheet gives you the what you call the confidence to do a number of things. One, invest ahead of time in terms of building technology skills, or in terms of market reach, or in terms of alliances, partnerships. So a strong balance sheet gives you that opportunities. Second is also, while we are very focused on growth, we are focused on how our margin performance is. We have to make those investments in the appropriate time, so that a strong balance sheet gives you that. And then, of course, in situations such as what happened recently, you are able to weather the storm much better if you have a strong balance sheet. But is that the reason for your success? I won't say that's the only reason. I think the intrinsic business model, the disciplined execution, and consistent strategy, what you call strategy definition and deployment. I think that is very important. And one has to stay true to the course through ups and downs. If you make too many changes into that, and companies get into trouble because of that.
I think, very valid thoughts, Ramakrishnan. So just, allow me to add one more point here. And if you could explain more on, are you confident about the discretionary spend right now? Or are you constant, and also are you constantly changing your hedging strategy because of the, rupee and fluctuations and everything? Because specifically in 2021, still there will be a lot of challenges. Obviously, we are on the threshold. But like you said, investment ahead of time is very, very important. So considering that, are you going to be very confident about infusing a lot of investments, making strong capex plans as a CFO? Or will you still consider a discretionary spending is a, what you can say, a tough time or something like that?
No, this is all very context specific. What is discretionary today may become non-discretionary at a different point
Right.
of time. So in terms of investments, I think we are not shying away from investments which are required from all those aspects which I talked about. So, and we have the strong balance sheet to support that. And we have through all these phases, technology changes as well as the business cycles. For instance, the global financial crisis of 2009 or later on the blips in the market. So we have been investing and will continue to do that. And in terms of, I think you asked about the discretionary spending. I think there are areas where we could do a variability, but I think as Mr. Bhatt also explained, not only in the Indian context, but also internationally, I think things are definitely different from what it was a few months back. So I think in that context, we also believe that FY22 will be definitely much better than what FY21 turned out to be. Globally, despite some of the things which are happening in terms of a second wave or the mutated strain and stuff like that, I think this will be much more, and I think resilient organizations will always be able to tide over this much better.
That I think was too good, Ramakrishnan sir. Jaimin sir, obviously you pointed out, good thoughts specifically on the retail segment and the corporate segment as well. My question to you, when I spoke to a lot of bankers in last, quarter, everybody talked about recovery is good, collection is good, and NPA is coming down. But what I also observed is that everybody is a bit cautious about the March quarter and they're worried about the March quarter. So how do you see the banking world specifically after the March quarter?
Actually, there's not so much to worry about March quarter if you look at. I mean, most of the prudent banks, I mean, I would talk for ourselves, and I guess most of the prudent banks, what they have done is made adequate provisions as we've gone along. Okay. And if you look at, you had scenarios as I talked about, moratorium 1, 2, you had restructuring, then you had this whole Supreme Court order, which effectively has meant that you will not call anybody NPAs effectively now from 1st September. So you're already 4.5 months or 5 months into it. Nobody has been called NPA in this period. So what do you do? As I said, most of the prudent one, including us, have made full provisions as if, the court order was not there. So if you've done that, you've already taken the cushion. And if you go back to early part of the year, the RBI had required all of us to make provisions on COVID. And you've had varying levels of provision, whatever the banks thought which was required at that point of time. So most of us have carried that provision even now, and not started dipping into it, though some of that may have been legally, I could have dipped into it and said, let me start reversing it. So as we speak, there is a reasonably adequate amount of provision which is there. And it is then for the banks to take assessment about whether you have adequacy of that or not. In fact, if I go back from a regulation point of view, Mr. RBI has said that, whatever COVID provisions you do not dip into by March, you can reverse. Now, some of us may want to take a view that while I might legally be able to reverse, is it okay for me to carry forward that in the next year, because some of the pain may go into the next year. But those are calls which we will take when it comes to the March ending and whatnot. But overall, I do think that if one has followed prudence, a large part of the pain which was there has gone in there. Even if you take the fact that the moratorium effectively ended on 31st of August, and then you discard, don't take into account the Supreme Court order, you therefore have had a whole 4-month period after that. So any pain level which had to come during this September to December has come in, and you've seen that. People who survived that period, I guess, are more likely to continue surviving. What you're of course seeing is there are people who did not pay in time earlier. Now they've started paying one installment, two installments. They may not be able to have the wherewithal to pay the whole overdue of maybe 3 months or whatnot. But if they've started paying one installment and their total, what we call internally as days past due, is not increasing, you are getting the comfort that it's carrying on. So my overall thing is, I guess a large part of the pain which one had to see is already in the bag, has been seen. Most of us have recognized. If people have not recognized, then they will have to take recognition of that very soon. But otherwise, I think the pain level is there, and it gives us the strength on the balance sheet to be able to go forward even further.
Quite interesting. And I have two, three more questions. But to begin with, we have a budget scheduled, just after 2 days, and I won't let you go before giving your hopes and expectations from the finance minister. So Ramakrishnan sir, I will start with you. If you could share your wish list from the finance minister. Being a CFO, I'm sure there are a lot of challenges and changes that we have seen in last 7, 8 months. But specifically, if I ask you, what are the changes that you would like FM to bring in the budget?
I think, as you rightly said, I think a lot of significant changes have been made,
Yes.
and which has helped us actually to tide over the situation in more ways than one realizes. I think Mr. Bhatt talked about the MSME sector, all the many such interventions. I think from a budget, I think a very macro view would be that I would believe that the fiscal deficit, etc., will not be an overhang, and if more money has to be there in the system, right, I think the government should be able to allow that, because temporarily, if we are able to have even a higher fiscal deficit, it should be all right. And many sectors are affected, so hopefully we should also not have too many changes in the tax provisions. A period of stability on some of those policies will always be very welcome.
Jaimin sir, your views?
No, I take Mr. Ramakrishnan's view. It's a scenario. We all watching the budget very clearly. It is going to be a very different one. There is a big need for growth. Right. So what are the push areas for growth which will come in? I guess everybody recognizes that areas like infrastructure and all will need to see growth. What will the government do there? And how do you balance that versus the fiscal deficit? Again, I would agree with Mr. Ramakrishnan that for some point of time, the government may be okay to go higher than what we would be normally used to on the fiscal deficit. So if one looks at that, some of that is, I think this may be a different year from what we've been doing earlier. And what are the areas which we could look at giving the thrust for growth? That is going to be the absolute key in terms of what happens there. Of course, on the flip side, I guess some of us may need to be willing to live with some kind of a COVID cess or whatnot, which will come in, so that we kind of do our contribution to what is happening around. But I think that's at least for temporarily something which we should expect. On specific sectors, I guess there are demands for each of the sectors, but the big area would be how is the balancing going to be between the growth and maintaining the fiscal discipline. But somewhere I would believe that growth will take priority over some amount of fiscal discipline, which we'll be able to pull back as we go forward.
Noted, Jaimin sir, and I will come back to, again, obviously we discussed in detail about the golden balance sheet. But Ramakrishnan sir, if we look at 2021 now, if you could share your ingredients to the financial professionals and CFOs who are watching this, session, that the ingredients which will make the golden balance sheet in 2021, what is that you are going to do so that your balance sheet will not only become gold, but a diamond, going ahead?
No, we will continue to do what we have been doing. I think we have a strong, the business model itself is a strong cash generation. So that is important, and because that feeds into the strength of your balance sheet. Also, from the right capital structure. In that, what I mean is it's not the gearing, but we generate significant cash. But that cash, to the extent where we need in our business and where there are opportunities, we use. But if the invested funds do not get adequate returns, because the returns have been dropping significantly over the last few years, the yields have been coming down. So if you are keeping that cash in your balance sheet without being able to use it in your business, because whatever is needed in the business is being invested, then it may be inefficient. So in terms of return to the shareholders is important. So we have been consistent on our policy of returning 80 to 100% of our free cash flow generated year on year. We'll continue to be focused on that because it makes it from both perspectives, both in the hands of the investors as well as the shareholders, and also from the company perspective, because that's a much more efficient use of the capital. The third one would be, I think, no number on your financial statement is too small or insignificant
Right.
from a CFO organization to look at. I think some of that, at a periodic times, we have to look at every number in the financial statement, be it the income statement or balance sheet, because it could be a sort of indicator of it could be something from a negative perspective, it could be an indicator of something where there is a lapse in an internal control or some process which is not working to the intended level. Or it could be just the inertia of large numbers, because people can lose sight of. On a positive side, there could be numbers where you can take some more actions to even strengthen what is happening. So I think that is that discipline has to be inculcated through the first in the finance team and in the other business teams who have an influence on that. And that I think I believe that we have been doing it very well, but we have to continue to do that and on a sustained basis. That's very important to make your balance sheet and your financial strength even more better.
Right. Jaimin sir, how are you going to react to this? Because many CFOs have taken a zero budget approach. They're still very conservative. So how are you, at Kotak Mahindra Bank, looking at balance sheet to make it more stronger than what it is today in 2021 or going ahead?
Ultimately, always believe the fact that it's the strength and the quality of the balance sheet which is more important, because balance sheet is there for you to stay and carry forward for the next period. P&L is behind you. So making sure that you have cleanliness on the balance sheet. First, of course, what's the quantum of capital you have, and you have the comfort of that to be able to have the growth capital to go from where you are. Because as you see going forward, if you believe that there is more growth coming in, do you have the capital to be able to grow, or will you need that? And if you have that, then how do you utilize that to get into which areas? Again, the cleanliness of the balance sheet. Being a bank, again, it's a reasonably opaque thing, but you have to make sure that what you believe on the asset side, what you have lent, what you've invested, is being reflected at the values you believe are the correct values. And that is where a lot of judgment comes in, a lot of areas where you need to be hand on heart very clear that what you have as the quality of your asset is the real quality which you believe, and that is what is going to stand you in good stead. Get less worried about the fact that, look, if something has gone bad, make a provision. The P&L may take a beating for a period, but at least you are able to go forward with a cleaner balance sheet, and therefore the problem is behind you. Don't forget the problem. If you have to recover it, fine. Take lessons from it, but don't carry forward the problem to a future date. It will remain with you how long? On the wish and hope that things will play out the way you want. It doesn't really happen. So making sure that if there is a pain, recognize the pain and get going on that. I mean, as I keep telling, I don't think there is any banker in the world who has not made a bad loan. So you will make a bad loan. The question is, if you made a bad loan, what lessons you learn from there, take the pain and go forward. And similarly, I think what this period has also taught us is a big focus as finance professionals on the internal controls and processes. Uh, you've got because you had to look at different measures during this period. You have got areas where you found that you have to improve upon, and how do you strengthen that? Because you would operate at variety of places all over the country. You are to some extent dependent on what is happening there. So you wake up to the fact that how would you control that one? Uh, One of the good things which has happened over the last whatever the whole of 2020, or at least bulk of it, has been because activity levels had slowed down. Most of the business teams also were more focused on cost, and you were able to bring those down. I think as pure control, what is important is as activity level picks up, as you get back to normalcy, how do you make some of what you have brought in as something which will stay with you permanently? And that's a challenge which one is going to face in the current year, and making sure that you carry that out going forward to make sure that some of the good learnings which were there take benefit of the crisis and go on there. One of the other things which could also throw up opportunities is the whole scenario which one has gone through, uh, are you having enough powder to look at possible bites of what you can get from others, whether it is acquisition of entities, acquisition of assets, and whatnot? In fact, I go back to the theme we had on the annual report of March 2020, when the pandemic had just started, and we put a ship which is in the middle of a storm at that point of time. Now, it is like all of us have left one shore to get to the other side of the shore, and we're caught in the storm. Uh, you had to make sure that your ship was strong enough and fortified to get to the other side. As you get to the other side, uh, there might be fewer people who would reach the other side. There might be other people who will reach the other side but may not be as strong. So, do you have the ability and the opportunity at that point of time to be able to step up your presence, step up your share on whatever the marketplace there? And if you get that, I think that would be an opportunity in what comes around after this. How do you look forward to that?
Absolutely. Being a bank, I'm sure that, and specifically a digital bank now, you have partnered with many fintechs and few startups. So here, I want to quickly take your suggestions specifically for the startups and fintech industries, because here the traditional CFOs saying that okay, you should do this, but the emerging CFO specifically from the startup and fintech ecosystem believes that raising fund is the only way you can make your balance sheet gold or a diamond format. So what is the suggestion, maybe one or two points that you would like to give to the startups or the fintech in terms of making their balance sheet really healthy?
No, that's a different world. So it's
Right.
like a lot of the larger players like us would be under watch of what you're doing every quarter, what you're doing every period, and how much will you be investing and whatnot. Whereas a fintech company or anybody in the startup world is certainly more. He cannot capitalize himself for his need for the next 2 years or 3 years, because he's dependent on how he will be able to raise funds, show progress on his balance sheet, or show progress in his activity levels, and then raise the next round of funds, possibly at higher values. So I think the models are very, very different. Uh, there is a cash burn there, which I don't think the larger players can look at the same model.
Right.
So to that extent, the outlook and the perspective of when you are at that size or that level is very different from when you are in a mature business and in different industry. So I think that's a different model. Uh, as I keep looking at it, as a lender, we may not be very comfortable lending to a startup because his model is dependent on the ability to raise equity all the time. But
Right.
if we like a good startup model, the best thing is, rather than lending to him, take a small equity, and
Right.
because otherwise, and you write the benefit of if he does that. So it's a different model, and I think those businesses will have to look at what's good for them.
Noted that. Ramakrishnan sir, Jaimin sir, that it's a different model and perhaps the traditional CFOs may not talk that call. How do you view the startups and the fintech ecosystem? Because they are treating balance sheet completely different.
Agree with Mr. Bhatt, because there is a different set of venture capital, etc., which looks at that risk and that reward very differently. But I think from from our sector, I think the startups then play a very important role, because many of them have uh, products and what you call platforms or niche areas where there is a huge opportunity to work together, and we have a uh, ecosystem of we call it the co-innovation network of thousands of startups, right, internationally.
Right.
I think the number is probably around 2,500, if I'm not mistaken.
Okay.
And these are startups, and where we work so that we can take their ideas to the market through our services and offerings, and they also get that opportunity for leading us to something which is built on some niche idea, right? So that is a very important ecosystem play, and some of them scale up, and we work with them on also in helping their own business to grow. So that is where we look at it. We do not directly invest in any of these opportunities, or it's more of a partnership. Where feed on each other's where we get strengths and relative strengths and also opportunities as they come along. It's not a financial investment in that sense.
Okay, noted, gentlemen. I'm done with my questions. But before I let you go, let me ask you one soft question, specifically, related to virtual world. So, Jaimin sir, if I ask you, what is the most important thing that you are missing in the virtual world?
I think personal connect beyond a point is important. And, there are things which comes with personal connect, especially if you're looking at the fact that, you've had people who've joined in new team members who come in even from other verticals into the team. That is something while the virtual world has taught us a lot, including, I guess, at a lot of times making life and work more productive, more efficient. But there is an amount of personal connect which you miss quite a few times.
Ramakrishnan sir?
No, I think I agree with you absolutely. I think a lot of advantages from the virtual world, but that social capital which you keep refreshing by meeting people, I think so that will come back. And the exact point which Mr. Bhatt made, we deal with, we are able to, even in the virtual world, we are able to do a lot of things because the person on the other end of the line, or whether it's an audio or a video call, you know that individual. The person also knows you and you know what to expect. But what do you do with completely a new set of employees, new set of team members? And it's mutual. They also do not know how they are dealing with. So that's going to be a challenge. So I think this 100% virtual world will not stay. It will be a hybrid world. And I would believe that that proportion is going to be, maybe time will tell how that proportion will lay out. But none of us can actually thrive in 100% virtual world. We need both the social connect and the interactions on a personal basis.
Absolutely. So that's it from my side, gentlemen. Thank you so much for sharing your views, and thank you so much for your participation at ETCFO Leadership Summit. It was really glad to have you and listen to both of you. Thank you so much.
Thank you.
Thank you.
Thank you. Thank you.